What is up, guys? It is John Fibonacci here, and in this video I want to discuss with you growing an account. All right, and if you haven't done so already, go ahead, hit the like button and hit the subscribe button as well, so that way you don't miss future content. I would appreciate that, and I believe you will too. Okay, so growing the account, right? People always want to know, how can I take good trades? How can I grow my account? How can I grow my equity? Right? That is usually the goal. And so we're just going to dive right into it. Okay. So part one, growing the account. The most important thing to remember in trading is capital preservation. Okay. Capital preservation is what keeps you around longer than everyone else who quickly washes out. Okay, most traders don't make it past their first year. And I know some of you have even heard of the 90-90-90 rule, where I think it's something like 90% of traders don't make it with their first 90 days, or blow their account by 90% within their first 90 days or something like that. Whatever it is. And it's true. Okay, in this career field, in this industry of trading, right, it has a high failure rate, and there's many reasons for that. But to counteract that, okay, or to combat that, is capital preservation, right? If you're more focused on really not losing, knowing when to trade, knowing when not to trade, it's going to keep you around longer. And being around longer than everyone else is half the battle right there. Okay, while everyone else is blowing their accounts or, getting washed out, you're able to stick around. Okay, and that's a win in itself. You do not need high risk trades. Okay, I meant to put, you do not need to take high-risk trades to grow an account, right? Leave the high risk to gamblers. We do not strive to be gamblers. We strive to be professional traders, okay? And you, like I said, you don't need high-risk trades. You don't. As much as you might think you do, or some young traders think that you need to risk 10%, 20% of the account, you don't need to do that. All right. As everyone should know already, as in the risk disclaimers as well, there is risk in trading. All right. There's always going to be risk every time you put on a live trade. Okay. And that's never going to change. That is always going to be a factor. If you have a live trade in the market, and you're trading a live account, there is risk involved. Okay. But we look to control the risk as much as possible. All right. Even though we may not control it the way that we want to, the best way to control risk, in my opinion, is to take trades that have a low risk. Right. And so by low risk, what I feel, okay, for low risk is anywhere from 0.5% to 2% account equity per trade. Okay. My normal risk recently has been 1%. Sometimes I'll bump it to 2%, if I feel it's one of those high probability trades, more so than just like a normal trade. And that's kind of hard to explain, because we always want to take high probability trades, but every once in a while you come across a trade and it just feels, different. It feels better than the other ones. And it doesn't happen often, but when I come across that type of scenario, those are the trades I'll put 2% on. But everything else is usually going to be 1%. Okay. And I'll get to why the 0.5% risk is in there in a little bit later in this video. And I know some of you might be thinking, oh, 0.5%, that's nothing. But trust me, you're going to understand that there's a reason for that. Okay. And it's very important. All right. So when I trade my setups, ideally what I like to look for at a bare minimum is going to be a 1 to 3 risk reward trade, meaning that if I'm risking $1, then I want to have at least $3 of return for every $1 of risk. Okay, and you can just scale that up. If I'm risking 10 to make 30 or 100 to make 300, so on and so forth. Okay, that's what that means. Now, ideally, right, 1 to 5 risk reward trades or higher, 1 to 6, 1 to 7, 1 to 10. I've had trades go 1 to 20, 1 to 50. It just really kind of depends. Now, I'm not going to really show you how to do that, how to get 1 to 50, 1 to 100 and stuff like that. It is possible, but to frame a trade like that for every single trade, I think is silly. I don't think it's possible. I've never seen anyone do it consistently. But I am able to consistently frame 1 to 3 risk reward trades, 1 to 5 risk reward trades. And I like it, because I'm able to grow my account, and there it is. All right. So I'm going to show you a trade that I was able to call out last week for my viewers and for the team. All right, we're looking at the Euro USD on a 15-minute time frame, okay? And right in the middle of this chart, maybe a little bit more so to the left, right where the highs are at, okay? That is where I was looking for short positions, okay? And I actually took a short position myself right in this area, but I'm going to show you the markup and really the idea behind this trade using the Fibonacci, the Fibonacci logic as taught on this YouTube channel. Okay. So if you drew a fib from the high to, I'll just have to use my mouse, from the high to the low, and then this retracement higher is the area that I was looking for to short. And what I've outlined here for you is risk reward trades based off the 618 level. Okay, so would you take drawdown on that? Yes. But we're not really more so focused on the entries or anything like that in this particular example. But I do want to show you the risk rewards that came from that particular setup. So immediately a 1 to 3 was met. And it's actually over here, but if you do the measurement, the 1 to 4 was met here, the 1 to 5 was met right here, and it went really as far as about a 1 to 8, maybe 1 to 8.5, something like that. And just to throw this in here as well, I'm not making it seem like, oh, you should have got the 1 to 8 or 1 to 8.5. That's not necessary. 1 to 3 is still good. 1 to 4, 5, obviously better. Ideally 1 to 8. But, in trading, you're not always going to be able to catch the low and the high. It can happen. I've done it in previous videos. You guys have seen me do that before. But even in that video, I said it's not every single trade. Okay, it's a very low percentage of my trades of actually getting in at the low, getting out at the high, or vice versa. In this example, where you would be getting in at the high and then getting out at the low. Again, just to clarify, you don't need the highest risk reward. Okay, the minimum 1 to 3 is achievable here. That's like the easiest in my opinion. And then that 1 to 8 is better, but not necessary. Okay. So moving on to part 2, handling drawdown. So in trading, losing is inevitable, right? You are going to take a losing trade at some point, even if you're on a winning streak. Okay. At some point, you will take a losing trade. All right. And so if I know that it is a fact that I will lose a trade at some point, then if I had to choose whether I want to lose a little bit or lose a medium amount or lose a large amount, if you were to ask me, if I knew I was going to lose, then I want to lose a very small amount. And with that being said, this is why my risk per trade is low. And if you refer back to part 1, 0.5%, 1%, 1.5%, all the way up to 2% per trade. Okay. and obviously anywhere in between 1.25% for whatever reason that you want to do that, but consistently on average, my risk is 1% per trade, and I'm fine with that. And that's where I live. Okay. A series of losing trades is likely to occur at some point in your career. When you decrease risk per losing trade instead of increasing risk, it will allow your account to avoid sharp decreases in equity. I know it's kind of a run-on sentence there a little bit, but basically the point is, I know there's like a martingale strategy out there where that in that particular money management style is where you increase risk per trade, and that's not what you want to do. All right. If you do the math, if you actually trade this way and you have data to back it up, which I do, I'm just not going to show you that here, but you can do the math yourself. Okay. When you're on a losing streak, if you decrease risk per losing trade, over time, your equity curve will be more smoothed out, okay? And that's actually, I'm going to get to that in a second. I know sometimes I get a little bit ahead of myself, but it is what it is. All right. Decreasing risk per trade may also keep more of your equity over a series of losing trades versus someone who takes the same loss amount every single trade. The trader that increases risk per trade sees an exponential decline in equity after a series of losses. This is the exact opposite of growing an account. Okay? And I do have a little bit of data that I will show you, and this is something that I was able to put together. This is a hypothetical scenario. This is not a real life example. I made this in Excel. Okay, so again, hypothetical example only, not with live funds. All right. This is a various account balance with consistent. I know I kind of misspelled that one too. Sorry about that, but it is what it is. All right. Starting with a hypothetical $10,000 starting balance. Trader 1 is the bottom blue line. They consistently lost the same amount per trade, losing 8 trades. The second trader was risking 1% per trade. And so at the end of the 8 losses, they were up a little bit more, not really that much. And trader 3, I believe, they cut their risk in half after 4 losses. Okay, so even though they took 8 losses in a row, the 4th, 5th, 6th, 7th, and 8th trade were half the original risk. So even though they were on a losing streak, they lost less after 8 losing trades. And then trader 4 and trader 5 consistently decreased their risk, or they would cut their risk in half after a certain number of losing trades, whether it be 4, whether it be 3, and I think this one was 2. Okay, so you see how in a losing streak, when you decrease your risk over a series of losing trades, you want to be the trader who has more capital over the ones who have the least amount of capital. Okay, so roughly $9,200 for the first couple of traders, around $9,400 for, hypothetically for this trader. And then the trader at the very top had about, I can't tell what that is, maybe $9,650 hypothetical dollars here. So in a real world example, right, which trader would you want to be? If your equity curve is going to go down from a series of losing trades, who would you rather be? And so in my experience, it would ideally, be this trader, but it's pretty acceptable to be any of these right in here. You don't want to be the trader down in here who lost the most. You would ideally want to be somewhere in here. Okay, so if you do the math, okay, and you do an equity curve over the long run, if every series of losing trades you were able to smooth out your equity curve, then this is where you want to be. Okay, and that's the idea behind it. Basically, the idea behind what it is that I'm explaining to you. Okay. So part 3, the last part, considerations. The goal is not to get rich quick. This is what leads to destruction, or also known as blown accounts, right? You don't want to blow your account. The goal is to build wealth over time. Consider planning months and years in advance. Trying to get rich quick is the easiest path to trading mistakes like over leveraging, over trading, and frustration, and all of that other negative stuff that comes with trying to get rich quick. Okay, it's just not a good idea to do that. Consider taking high probability trades and minimizing risk, not maximizing risk. But again, just kind of like I said earlier, my max risk would be 2%. But that only comes on certain trades, not every single one, very few. Okay, and that's even impossible for me to teach because I can't teach you intuition or that gut feeling. I can't. I don't know how to teach you that. So I'm sorry. I can't do it. All right. I am a human and I have limitations. All right. Here's a big one. Do not believe everything you see on social media. Social media allows us to be anyone that we want to be, but we can't fake real trading results. Social media influencers often fake their lifestyles, and chasing a dream will also lead to destruction and frustration. Now, I'm not here to start a war or call anyone out. I'm not going to name anyone specific. I'm just speaking generally. Okay, generally, social media is a facade, right? It's not real. Okay, and that's just the reality of it. Okay. So the last thing I want to leave you with is to take your time, right? Enjoy the process and study hard. Okay. With that being said, guys, thank you so much for watching. I appreciate it. If you haven't done so already, please give it a like. Make sure you are subscribed so that way you don't miss future content. All right. And I will see you in the next video.